25, 26 companies are said to be up for privatization in Kenya. With the exception of a few, it seems as though the process is very, very slow. Why is that?
I think I would look at it in terms of the structure of the privatization. Basically, and I think you can sort of look at it also in terms of industries. Some of the peers or some of the targets that are subject of privatization are basically operators not in the best industries or not in the most competitive industries. And that means that it's obviously much more difficult to sell them. Two is that most of the public enterprises that are subject of privatization themselves have always had weaknesses. Therefore, in terms of churning out things like operating data, financial data, it does take a while, and that as well impedes or impacts on the pace of privatization. Then when you talk of the privatization process itself, there are normally two stages. One is the preparation stage. And at the preparation stage, the advisors would normally carry out the due diligence of the entity. They would carry out valuation studies. They would determine any scope for restructuring and such related things. And that in itself could take up to about 6 months. Then you have the second process. The second process involves or entails now the preparation for sale and the recruitment of the investors themselves. And depending on the competitiveness of a country, that process as well could take another 6 to 12 months. So I think so long as the delays do not get to extraordinary periods above 18 months and so on, it may be considered to be reasonable. What is also true is privatizing about 25 companies within a short time does sort of pull a lot of resources from the Privatization Commission and even within amongst the advisory firms themselves. And that could also impact on the pace of privatization. And also finally, we shouldn't forget that Kenya as a destination, as an investment destination, was very competitive up to 2007. But a couple of things changed following the post-election violence. And obviously, most of the investors will always scrabble for those markets that are very, very competitive.
All right, Mr. Kiruthu, some who are looking at the workings of the Privatization Commission say that they need to set about a framework for regulation, especially because they're working with public enterprises across a variety of sectors, and any potential investor needs to know what are the codes of conduct, what are the rules, and a consistency in application.
I think consistency in terms of application. Okay, let's first of all look at the mandate for the Privatization Commission. Their mandate is really to implement the government's privatization strategy. What is true is that that could be subject to, or has a couple of challenges. Firstly, where the regulation is not totally clear, that means that the privatization process itself could get impacted upon. But I think most of the regulated sectors have been sorted out. And two is that not all industries are regulated within Kenya. In terms of the Privatization Commission itself, the regulatory environment, I think the law is very clear on what they must do, what they must achieve, and the process that must be followed to secure investors.
You refer to valuation and due diligence. That forms a core function of the preparations needed for the privatization process. If we just look at one example, for instance, France Telecom buying into Telkom Kenya and introducing Orange, that whole process seems to be very flawed from the perspective of the French. They say that they've paid over $300 million for an empty shell, and they, from their side, they did everything that needed to be done, but they suggest that maybe there wasn't sufficient goodwill on the parts of the Kenyans.
I know it's a contractual matter, so I may not be able to, or I might not be competent to comment on this, but I think it's good to look at the process itself. What is clear to us, or what is clear to me for that matter, is that bidders were invited to carry out a due diligence and also carry out the evaluation and any other studies that were necessary prior to putting in the bids. Also, another statement of fact is that 3 bids were submitted, or 3 parties had been pre-qualified to submit, in fact 4 parties had been pre-qualified to submit the bids. 3 bids were received. And if you look at the range of values, I think the lowest bidder had quoted something like 220 million US. There was another bidder with about 280 million US. And the winning bidder quoted something like over 300 million US. What I do agree is that depending on the quality of information and many other aspects of the studies, it's possible at times for the people carrying out the due diligence or people preparing the bid to fail to capture some important information. But the bid range, you know, amongst 3 bidders who are competing amongst themselves, between 220 million to past 300, sort of tells you where the valuation range was actually lying.
Right.
The rest of it, I think, could be considered as a dynamic of competition.
All right, let's also talk about the
What
fact
is also true is,
let's talk about the fact that many of
situation.
these, let's also talk about the fact that you refer that many of these public entities don't run efficiently, and hence the pressure to privatize. Is there, because of that, is there the likelihood that they would be sold at a loss just to recover the initial costs, and the government would not be getting any of its value back from the shareholding?
What we do know is that under the Privatization Commission, or under the Privatization Act 2005, there is a requirement that for every public enterprise that is to be put into the market, there must be a reserve price. That reserve price should be predicated on some valuation work carried out either by the government itself or whoever is appointed as an advisor for that specific transaction. So in other words, that should sort of mitigate the scope of entities or enterprises being sold at a loss. 2 is that so long as you have a number of bidders, if the bidders are not affiliated, if they are all sort of independent, normally a tender situation should result in a situation where the highest bidder pays more than the fair value.
Right.
And we normally term fair value as the price that would exchange hands between a willing buyer, willing seller, under no compulsion to act, and where both parties have full facts and reasonable information regarding the specific transaction.
All right, John Kiruthu, thank you very much for coming through, a partner for corporate finance and transactions at KPMG. Kenya undergoing privatization. South Africa's tried it, and the unions were outraged.
Yes, indeed. But actually, if you look at privatization in South Africa, it was reasonably successful in the sense that the government actually got fairly good money for the enterprises they sold. But in South Africa, we followed a process of first commercialization, meaning it needs to be run as a proper business, but with government as its only shareholder, and then it can be privatized. Now, SAA, for instance, is in the middle part of that process, but the last part never happened. But what we have to say in Kenya is, the fantastic news is they're privatizing. The bad news is it's a little bit slow, and there are a couple of hiccups. In South Africa, the bad news is we're talking about nationalization. The good news is they're also very slow.
But before we get to nationalization, I think for many investors, it's the bridge between the buying at a premium and selling at a loss.
Yes. Well, there are 2 different things that you want to get right through the nationalization. The one is you want the companies to be run better and commercially by private shareholders. The other is you want the government to have reasonable income from selling it. The first one is much more important, because once these things are privatized and they run at a profit, then they start paying tax, so the government gets their share anyway. So faster privatization means faster reform, more tax, better economy.